On December 12, 1791, Alexander Hamilton, the first Secretary of the Treasury, laid the foundations of the American financial system by establishing a central bank, the Bank of the United States. However, just over a year later, by March 1792, banks faced an extreme credit crunch as George Clinton, an ally to Thomas Jefferson who was opposed to the Bank of the United States, and his friends withdrew large amounts of money from the city banks, creating a credit shortage. It was in their interest to help Thomas Jefferson and his cause by doing anything they could to make the banks fail or cause them some sort of embarrassment. William Duer, man put in charge of promoting industrial development in New Jersey, was a master salesman and speculator. He engaged in a scheme where he planned to corner the market on US debt securities and bank stocks, doing this by borrowing hundreds of thousands of dollars. However, when he defaulted on those loans, prices fell, causing a bank run and leading to the nation's first financial panic.
My God! Okay, it's happening. Everybody stay calm.
What's the procedure, everyone? What's the procedure?
Stay calm!
On May 17, 1792, 24 stockbrokers outside of Wall Street signed something called the Buttonwood Agreement. This agreement set up trading rules to reestablish confidence after the financial panic of 1792, leading to what we know now as the New York Stock Exchange. Since then, people have invested over $25 trillion because it provides a potential for higher returns compared to alternatives such as bank certificates or treasury bonds, while also offering the ability to protect people from inflation as well as earn passive income from dividends. Many people have amassed giant amounts of wealth through the New York Stock Exchange. In fact, in 2022 alone, over 1 million new millionaires were created.
That's how much I'm worth. $20 million.
Yeah. However, according to new data, America's super wealthy, those as defined with 1 million or more investable assets, are pulling out. Those ultra wealthy now hold over 34% of their portfolio in cash, reducing their exposure to the stock market by the most dramatic margin in years.
But why?
Well, unless you live under a rock, you know that rampant inflation and rising interest rates have made the stock market less attractive. But what are the ultra wealthy doing with their money instead? According to the UBS Global Family Office Report, which surveys families with over $100 million in investable assets, investors are looking for alternative assets and fixed income securities. People in this group of ultra wealthy are planning to increase their exposure more predictable type of investments by 12 to 18% this year. Private equity and private credit are also on the radar of these families, with returns on private credit deals potentially in the 12 to 15% range. But what does that mean for those of us who aren't considered ultra wealthy?
Well, we call you normies.
Unfortunately, with the barrier of entry on private equity and private credit so high, retail traders don't typically enjoy the same access to alternative investments as the ultra wealthy. The barrier of entry is just simply too high. However, there are some attractive opportunities on the horizon.
Bring me that horizon.
For the average investors looking for somewhere to put their money as the feds continue to raise rates to try to fight inflation. The SPDR Portfolio High Yield Bond EFT, for example, offers a yield to maturity of 8.81%. This fund invests in corporate bonds that are below investment grade and therefore carry more risk. Meanwhile, investment grade corporate bonds with a AAA credit rate currently offer an average yield of 4.74%. With fixed income investment yields growing, average investors might want to consider parking some cash in these instruments. Bonds haven't really been popular for decades, but as investors search for safer places to park their money, these instruments are starting to see a resurgence.